is the latest installment of Credit Trends in Commercial Lending, Credit Risk Navigator, presented by Tom Cronin from AFS. During the presentation, if you have any questions for the speaker, please submit using the Q&A feature at the bottom of your Zoom screen. We will address as many of your questions as we can at the end of the presentation. At this time, I would like to turn it over to Tom Cronin from AFS. Thanks for joining us today. And also, Tom, you might want to change your display settings. It's showing the preview slide, I think.
All right, hold on a second. That better?
Yep. Yes.
Okay. All right. So thank you, Carly, and Happy New Year to all. I think we can still say that since it's January. Today, we're going to analyze the December 2022 data. And of the 11 webcasts we hold each year, to be honest, this one's my favorite. I really like to look at the performance over an entire year to see what problems we had, what sectors had improved, and what appears to be in trouble. So you'll see a lot of year-to-year comparisons today. And along with the standard charts that you see each month, if you join us each month, we have a couple of new looks. And so as always, at the end of the webcast, if you complete the survey, you can let us know what you liked or what else you wanted to see. So where do we get our data? The Credit Risk Navigator is the oldest monthly commercial loan performance and credit quality database in the US. And that's where all the data comes from today. The CRN, as we call it, is now available via an updated dashboard, as seen here on the left side. AFS receives the data from member banks each month. We process and verify that information and return the results in less than 30 days to each bank. And member banks are also entitled to participate in 2 user-only meetings each year, where we dive a little deeper into the results and have open discussions on topics pertinent to portfolio management, such as attribution analysis or loan growth. So if you'd like to learn more, please contact either Carly or myself. Our emails will be at the end of this presentation. Before we jump into the CRN results, I thought we'd set the stage with some overall economic data that either impacting performance or representative of what's happening. So here I picked 4 charts to show you just really at random. The one in the upper left is the existing home sales annual rate, and you can see it was very strong up until the fall and then has since dropped, and we'll see the reason why in a second, but is now down to about 4 million units. Directly to the right of that is the retail sales month over month, again, had been very strong and very recently retreated into the negative range. Bottom left is inflation rate, which had capped, I think it's 9% there in June, a little over 9%, and has dramatically slowed since that time. And then the last one, the Fed funds rate, which is just to the lower right. And you can see that's been marching up quite steadily and has impacted all 3 of these other charts. All right. So here's where we're going to do a couple of polls questions today. And this is where we want to launch our first one, Carly, regarding the recessions. So the question, and we would ask this a while ago, but we want to ask it again, is are you expecting a recession in 2023? And just simply check yes, no, or not sure. And we'll wait a little bit for the answers. Okay, so we're at 62% yes, 15% no, and 24% not sure. All right, so we'll keep this in mind as we go through today, because I think that pretty much mirrors what a lot of people are expecting, with the possibility maybe they're not sure. But it seems like everybody's expecting a recession sometime this year. Okay. So let's start. So C&I, this is the commercial industrial. We'll start with this. We split each bank's portfolio into two parts, C&I and CRE. Here's our definition of C&I. C&I is loans to borrowers for business purposes. This is usually to companies with annual sales north of $1 million. And these loans are manually underwritten and risk rated. And as an example, a loan secured by owner-occupied real estate is called C&I. So our first chart is the chart we usually start with. It's the C&I performance chart showing the delinquency and non-accrual results since the third quarter of 2003. And if you joined us before, I know I'm going to sound like a broken record here, but when compared to non-accruals, delinquencies are extremely volatile. On the chart, you can see the spikes in 08 and 09 due to the recession. And then lately, during the COVID era, these fluctuations have been even more pronounced. And now for December versus November, we experienced another huge shift. This time we dropped more than 50% from 0.51 to 0.22%, close to service lows. Now the drop in past dues occurred for almost 75% of the members of our banks. So we canvassed the contributors and discovered that for many banks in the month of December, there was a concentrated effort to rein in delinquencies, especially the short-term delinquencies that you see there in the light, we'll call this light green. And you might recall, we've been talking about the high level of delinquencies for most of 2022. And the reason we heard was that these delinquencies were not true credit issues, they were administrative issues, such as slow payment processing, slow renewals, etc. And with this cleanup, it seems that the administrative issue reasoning was in fact true. So we'll stay low on this for a while. Let's move on to non-accruals, the dark blue line. For 2022, the non-accrual level has stayed in the 50s, 0.50s. We're now at 0.55. We've had a high of 0.59 this year and a low of 0.51. So we've been in a very, very narrow band. And you can see we've completely recovered from the COVID high of 0.9% that we had in November of 2020. And we're actually back to pre-recession levels. We haven't been this low since the 07-08 timeframe. And I believe if we've been trying to predict performance at the beginning of this year, at the beginning of 2022, I don't think we would have said that the levels would be pre-recession, given the inflation, the threat of increases of interest rates, and the war in Ukraine. A much dire prediction would have been more reasonable. But the C&I portfolio has been very resilient since the recession, and so far has weathered these geopolitical and economic storms as a whole. However, there are a few weak sectors, and we want to take a look at some of those. So here's non-accrual ratios by industry, and I refer to this as my above the line chart. The horizontal line represents the all industry average for December 2022. Each column represents the percent non-accruing for each two-digit NAICS code. So any column that is above the line is currently worse than average, and opposite of that, any column below the line is obviously better than average. And there are three sectors that are clearly performing poorly. Those are, starting on the left and going to the right, 11 ag, 31 manufacturing, and 56 admin and support. We're going to talk about ag in a minute, but for 31 manufacturing, we're seeing elevated levels for soft drink and wine manufacturing, which just happen to be in the consumer staples industry, or consumer's discretionary is another term. And then for 56 admin, the issue is with facility support, and that's office, and then office services and security guard services, which is also office related. And I mentioned this because when we look at CRE, we're going to talk a little bit more about office and the outlook for offices. So now we're going to look at, or here we look at the change in the percent non-accruing on the next two charts. It's the same data behind each chart, just different visuals. So let me take a second to explain, pardon me, what we've done with this first chart. So for each 2-digit NAICS code, we have a column and a circle. The circle is the percent non-accruing as of December 2021, so last year, and the column is the percent non-accruing as of December 2022. You see several circles floating above the columns. 21 mining, oil, and gas is probably the best example. And these are examples of industry sectors that have improved. So their December 22 non-accrual level is below December 2021. And there are just a few that are trending in the opposite way. The two sectors that had the most significant deterioration over the past 12 months are 11 ag and 31 manufacturing. We just talked a little bit about manufacturing, so let's mention what's going on with ag. And what's happening here is the combination of the almost nationwide drought, having an impact in decreasing yields, and then the high inflation increasing expenses for feed, fuel, and fertilizer has been a devastating 1-2 punch to ag profitability. And those were the only two sectors that really had any big drops. So on the next slide, we're going to take a slightly different take on the changes. And this is obviously a table, same information as on the chart, but I've separated the changes into improvements and declines or declinations, and then 3 buckets of change within each of those sectors. And this is, I take the number for December 22 minus the number of December 21. So you see anything that's a negative is an improvement. Anything that's a positive is a deterioration or a decline. And if you just look at this without trying to interpret right off the bat, you see that most of the industries are in the middle and actually had very little change over the past 12 months. So most of the industries for 2022 didn't change much. It's very clear that there are only 5 sectors, 3 at the extreme right, 3 at the extreme left and 2 at the extreme right that had any significant movement. The 3 on the left, oil and gas, arts, and hotels, are sectors that were all hit hard by the COVID restrictions, but have since rebounded as people have gotten back on the roads, gotten back into the gyms, started traveling again, and going to conventions. And then the 2 on the right, 31 manufacturing and 11 ag, we've discussed the drought and the increase in fertilizer and fuel prices has impacted ag. And then 31 manufacturing, the soft drink and wine manufacturing. So issues that are just kind of related, 2 separate issues, but very related to just a few industries. Now we're going to move on to percent non-accruing by geography or by region. And a quick explanation, when we assign a borrower to region, we use the address of the borrower, not the bank. So a loan to FedEx gets tagged as being from Tennessee, regardless of who the bank was. And this chart has changed significantly over the past year plus, especially when you compare the South and the Southwest. The South had been one of the best regions. It's now the worst. And the Southwest had been the worst. It's now one of the best. And here we have December 21 versus December 22 to show the change, again, with the circles and the columns. And as we just mentioned, you see the movement in the opposite directions for the South and the Southwest. The South circle is within the bar or the column. The Southwest circle is floating far above it. We're going to take a look at what's going on in the South on just the next slide. But I did want to mention that we also found an increase in non-accruals for the West. And that was due primarily to defaults, once again, for agriculture and 31 manufacturing. So those 2 industries are having problems, it seems, in a number of regions. So we mentioned that the percent non-accruing levels in the South have jumped significantly over the past 12 months. And I thought it'd be worthwhile to see exactly what's causing the increase in the non-accruals. So I've pulled the percent non-accruing for each 2-digit NAICS code within the South region and arrange them high to low on this funnel chart. And once again, it's interesting to see that the two worst sectors for the South are also the two worst sectors for the entire country. And I'd also make note that 2 of the top 5 highest non-accrual levels here are for manufacturing. And Carly and I have talked about this before. And one of the things we found is that manufacturing is one of the first sectors to go into a decline at the beginning of the recession. So just something to keep in mind. All right, so next we're going to switch into credit quality, but we wanted to launch another poll question, this one regarding risk ratings and how often do you change risk ratings? So we'll let Carly pull that up.
Yep, sorry, pulling it up now. Here we go.
Okay, so the question is, how often do you update or review your risk ratings? And your choices are quarterly, semi-annually, annually, or only with a change in financials. And when I say only with a change in financials, that would be a significant change, say a tremendous drop in sales or a loss instead of a profit. So we're just curious as to how banks handle this. And so we'll wait a little bit for people to answer.
Almost full participation.
Okay. All right. So we have 26% quarterly, 4% semi-annual, annual 53, and change in financial 17. Okay. I'm really surprised by that quarterly number. But we'll go ahead. So we wanted to now look at the credit quality. And in the Credit Risk Navigator, when a bank first joins credit risk, the process, one of the first exercises that occurs is to map their borrower risk ratings, whether that's 0 to 10, 0 to 20, 1 to 20, whatever they have. We map them into the RMA 10-point scale. And on that scale, borrowers rated 1 through 6 are called pass. And then those 7 through 10 are criticized. And so you end up with a weighted average risk rating here based on, again, the 10-point scale. If they're up in the 5, so you're getting a little bit in the high pass zone. 4s are much better as you go along. So on this chart, we plotted the weighted average risk rating for all borrowers over the life of the service. We were at 5.25 at the height of the recession in early 2010. And then you can see the recovery that all the way down to the end of 2018, we were at a weighted average risk rating of 4.33. Then COVID hit, and by the end of 2020, the average was back up to 4.81, just a little bit below 5. But as businesses have reopened, the credit quality improved, and now we're back to 4.51. So we wanted to take a little closer look at the criticized piece of that. So the 1 through 6 is passed, 7 through 10 is criticized, and that's what we want to look at here, the criticized. And again, this is over the life of the loan. You can see that this pretty much mirrors the overall weighted average risk rating trend chart, at least in direction. But the primary difference is that right now we are at a service level low for percent criticized. So the troubled loans, if you would, we've never seen so few troubled loans since the service started in 2003. And here we have the percent criticized by NAICS. The solid line, again, this is what I call an above the line chart. The solid line is the percent overall average. And when you get a chance and you have this PowerPoint or PDF, compare this chart to the non-accrual above the line chart, and you'll see several differences. Here, 45 retail and 48 transportation are the highest. highest criticized. On the non-accrual chart, they are actually below average. The three manufacturings are just about equal here. On the non-accrual chart, 31 is much higher than the other two. And just a little note, the differences between the ratings and the performances is something we explored during our user group meetings, if that would be of interest to you. And once again, we're looking at the December 2021 and the December 2022 results. The circle is December 21, the column is December 22. A floating circle shows an improvement, and just about every sector is showing an improvement or at least stayed steady. The only sectors with significant declines or increases in percent criticized are 61 education and 62 healthcare. And we've talked a little bit about healthcare in the past, and the problems there being primarily nursing homes and how people are not returning to nursing homes post-pandemic. All right, now we're going to move on to CRE, commercial real estate part of the portfolio. And when we say CRE, we're matching the interagency guidance definition of CRE. Basically, if more than 50% of the loan payment comes from the sale or lease of the property, it's CRE. And you'll also see us refer to CRE as investor-owned properties. Here we have the delinquency and non-accruals trends since we started CRE in late 2010. And let's focus on the past 12 months and start with delinquencies, especially the 30 to 59 days, which is the light blue. Similar to what we saw with the C&I delinquencies, there's been a lot of volatility over the past 12 months. We saw a low of 0.13% in February, a high of 0.84% just last month, and now 0.56% for December. And again, the cleanup that was in place for that we mentioned with the C&I delinquencies was also impacted here or applied to here. For the non-accruals, pardon me, the first half of this year was pretty good. We went from 0.84% in January to 0.77% in May, but then the percent non-accruing started climbing, and we now sit above 1 at 1.04%. In a minute, we'll see why, but I wanted to point out the difference, at least in non-accruals, between C&I and CRE. If you recall our first chart, C&I and non-accruals went up for COVID, but now have fully recovered and are close to service lows. With CRE, however, it went up for COVID, started to come back down, but now are climbing up again. We've not fully recovered from the COVID impact on CRE properties. And again, we're going to take a look at some specific properties and discuss what's happening. So here's one of our new looks. And these are the non-accrual levels for the 8 largest property types. And when I say largest, I'm referring to balances. And this 3D chart shows the non-accruals for December 2021 on the left, and then the December 2022 non-accruals on the right, or the inner property, if you would. And if you look at this, you can see that the chart's dominated by the lodging results, which have improved this year. But we just mentioned, pardon me, that over the past half of the year, overall non-accruals for CRE have gone up. So while lodgings come down in the green towers, if you would, healthcare in the dark blue, mixed use in the orange, and office in the red have all climbed. We also see a very small increase for retail. And we've been anticipating these problems, pardon me, for some time now, especially for the office properties. The return to office remains low, and recent layoffs, most notably in the tech sector, probably won't help the office outlook or performance. So here's the overall trend. Pardon me, hold on a second. The overall trend in weighted average risk ratings. Pre-COVID, we were just below 4.75%. You see that in the dip there, 0.19. But by the end of 2020, the weighted average risk rating had climbed to 517. It recovered and was at 485 in September of 2022. But just like we saw with non-accruals, we're up again. And December 2022, we're at 4.98%. So let's look at the criticized trend. And again, these are facilities risk rated 7 through 10, special mention, substandard, doubtful, and loss. And this chart, we're just focusing on the COVID era results. And you see the initial acceleration due to the COVID restrictions for criticized in 2020, reaching, I think it was actually 10.26 in October of 2020. We recovered from that number, and we're doing pretty well through the early part of 2022. But now, same as what we saw, the non-accruals and the overall weighted average risk rating, we're headed in the wrong direction. And once more, I'll repeat myself. Over the past 6 months, CRE is going in the opposite direction of C&I. So let's look at the credit quality for major property types. And what we find here is very similar to what we saw in the change in non-accruing by property type, a recurring theme for CRE. Lodging has improved even more dramatically here than the performance numbers, but that improvement is being offset by increases in ratings for the following property types: healthcare, which we know is mainly nursing homes, office properties, which is just about doubled, and then smaller increases for mixed use and residential. So I remember when COVID first hit, Stephen Martin of the RMA had wondered when the decline for offices would come. It's taken much longer than we thought, but it actually looks like it's here. All right, so that ends the presentation, but we wanted to finish with one more poll question. Now that you've been educated on the industries and property types that are how they're performing. So Carly, can we launch the last poll question? So with the economy projected to weaken this year, what do you think is the most vulnerable industries? And here you can select more than one or more answers. Totally up to you as to what you think is going to have problems. And again, we'll wait a little bit for your answers, and then we'll open it up for questions. All right. So 50, the top two, I think, are commercial real estate, consumer discretionary, infotech, and financials. Okay. And healthcare, 31. All right, and nobody. Okay, oops, Carly, there's some, let me pull down the bottom so everybody can see. There, 36 for ag. Okay. Well, thank you very much for attending today. If there's any questions, we'll open it up for questions now. And again, I'll just mention at when we sign off, there is the survey at the end. If there's anything you want to see going forward, or anything that specifically you want to have looked at, if you answer the survey or send either Carly or myself an email, we'd be glad to respond to you.
We do have one question. It is, do you have a geography map? What states are included in what region?
Okay. So there's the geography map. And pardon me, lose my voice. This is at the end of the presentation that you'll receive.
And another question is, do you know what the softness in mixed use properties is attributable to?
From what I've seen, pardon me, the mixed use properties that are having problems are the ones that are a combination of office and retail. A lot of the mixed use properties are apartments on the top and retail on the bottom. The ones that I've seen that have gone into non-accrual have been office at the top and retail on the bottom. Just been a softness in getting these properties fully leased. And a lot of these are in the urban district, not in the suburban district.
We have a question. What industries make up the higher non-accrual in that region?
In which particular, does it say which region?
No, it doesn't specify.
Oh, so if whoever wrote that, if you could send me an email specifying which region, unless I'm misunderstanding the question. But if you could send me an email with the region that you want to see, I can get that information back to you.
The South.
The South?
Yes.
Oh, so that's, let's see if I can go back. That's here. So it's the interesting enough, it's the same, the top of the house are the same three that are not performing well throughout the country. So it's ag, manufacturing, and admin support. And I would make a note that in ag, the problems we're seeing are primarily for crop production, not animal production. So it's the crop production, which from what we've been able to discern is the direct result of the drought, and then increase in the 3 F's, the fuel, feed, and fertilizer increased prices are just causing havoc.
We have another question that is, with a looming recession, how do you expect landlords for multifamily to react in terms of rent increases?
So what I've seen is that your rent increases are going to be very minimal. As the recession hits and people get laid off, these huge rent increases that you've seen are going to go away. And I think there's already data out there that suggests the rent increases have slowed, but everything I see is indicating that they're even going to get slower, and you'll see a little. It'll be tougher to raise rent. So whatever cash flow you have now is going to be constricted even more, because if you figure that debt payments are going to increase with the increase in rates, you're not going to be able to offset that with increased rent. So your properties, better be cash flowing pretty well.
Okay, that is all the questions that we had. I know that some folks got in a little bit late because of some technical difficulties on our side. So I will go ahead and send out the recording so people can see what they missed, because there's a lot of really great content at the beginning. But thanks. If there are no more questions, a big thank you to everyone for participating today. And a thank you to Tom for giving us all these fantastic insights. If you do have any additional questions about the Credit Risk Navigator product, we would be more than happy to answer those for you. You can see our emails below there. Definitely, you can get a lot more deep insights into what's going on in certain industries, and particularly as it relates to your financial institutions. So definitely recommend reaching out to us if you are looking for a little bit more information on that. And hope everyone has a wonderful rest of their day. And thank you so much for participating.
Thanks, Carly.